the way I see the market is, and the where we've just been, is that, essentially zero interest rates have inflated assets for years, as there's been no time cost of money. So most assets have constantly gone up, and they've gone up a lot. And then there's a macro trend of the rest of the world getting rich, which has added huge incremental demand on truly scarce wines, which is, of course, resolved by higher prices. COVID and the great unlocking combined to create a protracted sort of sugar rush, which inevitably dragged a good deal of consumption from the future. That sugar rush was then exhausted at the time. A multi-decade trend of lower interest rates reversed, and suddenly credit was expensive and scarce. And this always weighs on risk assets. So it's not a surprise to me that, after having had a huge amount of demand in this extraordinary event through COVID, and also because of the lower interest rates, that when we come out of it and we've suddenly spent a lot of money, and we've done it with cheap money, we suddenly have expensive money. We bought too much, so it's not surprising that demand somewhat sags. The positive interest rates will start dragging down the future value as well. So you're suddenly having, with higher interest rates, suddenly you have to think about, well, if you say that money costs me 7% a year, that means a wine you bought for £100 this year has got to be worth double that in 10 years just to cover the cost of money. Well, that hasn't been something we've had to factor in. So if you're buying something today, or in this period of high interest rates, you suddenly have to think, well, it's not just going to go up. If it's going to go up, it's also got to go up by the value of the money, and maybe money isn't even as easy to get as it used to be. So these are all good reasons why you'd see a correction in the market. And also last year we had in the economy generally a sort of tightening of liquidity, and that generally means that there was a lack of availability of liquidity to help investors push money into risk assets, and that of course had an effect on wine as it did on everything else. So we've had a boom, we've had a correction. This sets valuations at more realistic levels generally. And I think we're entering a phase of opportunity to buy back into the best wines that are now more reasonably priced. I do think that, a lot of wines have gone too far, too fast. And I think they will probably take a while to sort of allow gravity to re-establish some more realistic place for them to be. But I think in all of that, there's an awful lot of wine which is now more correctly priced. And I think we're moving into a far more benign liquidity cycle, part of the cycle, where there's going to be more money and easier availability to credit, which I think will. And we'll also have the prospect of lower interest rates now. I think the post sort of COVID sugar rush, was really sort of stopped in its tracks further by the fact that we had these high interest rates, which really spooked everybody, because we haven't had those for decades, really. But I think all the narrative now is to, no more increasing interest rates. In fact, the expectation is going down. We're already seeing that reflected in mortgage rates. I mean, all of those things are going to combine to push more money into risk assets. And frankly, I think, wine will get its fair share of that. I do think we've also had, I think we have sentiment very bruised in our trade. I think some participants have been structurally affected by such low levels of trading, and some are probably hold below the waterline. I expect there'll be a combo of some casualties, some consolidation, some innovation, and then some recovery. I mean, of course, at the end, you've got, people always underestimate the externalities. We have wars, cartoon politics, and outlier events such as COVID all make us uncertain and therefore more cautious. So I think, that's quite a cocktail. But I do think there are good structural long-term reasons why wine will continue to go up. It should have some volatility attached to it. The fact that we haven't seen much volatility for a while has spooked people, because they were just, it was kind of like, it was a bit like the days of Bitcoin where sort of, price goes up sort of thing. And people just sort of bought thinking, well, there's not enough of it. Everybody wants it. We can all be sure we can sell it. And now I think we've realized that the world isn't quite so simple. To summarize, I think, there's some very good reasons why we've been through the period we've been through. I think it's good that we had a correction because it is cathartic. It tends to sort of flush out some some bad behaviors. And I think that the macro environment is very conducive to a recovery. But as I said, the health warning is really the externalities we can't control. Anyway, that's my view.